Hello and welcome to another executive interview here at Freetrade. I'm Dan Lane. A quick reminder to sign up to our daily market newsletter, Honey, for everything that's going on in the markets every day. You can do that using the link below. And today I'm joined by Elmley Cour from the Association of Investment Companies to talk all things investment trusts. Elmley, thanks for coming in.
Good to see you, Dan. Thanks.
So I thought, listen, no better place to start. Can you tell us what are investment trusts?
Of course. So investment trusts are funds. So they pool together lots of individual investors' money to be spread across a diversified portfolio of different assets. They are actively managed. So a fund manager or team of fund managers works to beat a benchmark index rather than just match the performance of that index. What makes trusts a little bit different is that they're actually companies in their own right. So they're PLCs and listed on a stock exchange, just like Amazon, Apple, Tesco. So you invest in an investment trust by buying their shares on the stock exchange. Investment trusts are actually one of the oldest forms of fund available. Their history goes back over 150 years, and some of the first investment trusts are still available to be invested in today. But today, despite having this history, they provide exposure to some of the most cutting edge investment opportunities possible. So there's this nice kind of track record, but also looking to the horizon. There's about 400 investment trusts in total, and they're listed on the London Stock Exchange.
So yeah, listen, you've described it better than I ever could there. I think keen honey watchers will have seen we actually had Paul Niven from the FNC Investment Trust in, which is just the granddaddy of them all. But I think more broadly, when it comes to kind of a single product that invests in a basket of stocks, a lot of people will be more familiar with ETFs or even open-ended funds for that. What is specifically different about the trust?
The biggest difference is that investment trusts have what's called a closed-ended structure. So that's opposed to ETFs or open-ended funds, which have an open-ended structure. And what that really means is that investment trusts have a fixed number of shares which investors buy and sell between each other on the stock exchange, rather than an open-ended fund, which gets bigger and smaller as investors move money in and out of the fund. So what this really means is that when you buy shares in an investment trust, it has no impact on the underlying portfolio of the trust because you're doing the trading on the stock exchange between other investors. So that might sound like kind of quite a sort of technical difference, but actually it has a huge impact. Because the trading has no impact on the underlying portfolio, it means an investment trust can invest in a much wider range of assets. So particularly things that are quite illiquid and can take a long time to buy and sell. If you're investing in an open-ended fund or an ETF, if you want to redeem your money, the manager will have to sell the assets to then give you your money back. So they have to be invested in things which are quite liquid and things that you can kind of liquidate very quickly. Investment trust, there's no such restrictions. So investment trust can provide you access to a huge range of other assets, which we'll probably come on to in more detail a bit later. So closed-ended structure is one of the really big differences. The other one is the fact that they're companies in their own right. Because they're PLCs, they have an independent board of directors, just like Amazon, Apple, Tesla, any single stock company you can think of. But what that really means to you as an investor is that you have an independent board of directors who have a legal duty to represent your interests in the trust. For an investment trust, it is the board that actually then hires the asset manager to run the fund on a day-to-day basis. So people like Baillie Gifford or JP Morgan. So the board can hire and fire the fund manager if performance is poor. They can hold the manager to account. They can lower fees and negotiate on behalf of shareholders. This is very different to investing in an ETF or an open-ended fund, which are ultimately sort of products provided by an asset manager. So you've got this extra level of governance representing your interests. Because they're companies as well, with an investment trust, you're a shareholder. So you can vote on issues affecting the trust, you can attend AGMs, you can ask questions of the board and manager. There's much more of a kind of two-way relationship when you're a shareholder of the trust.
And I guess one of the things that we've been focused on in most recent years is that accountability. Actually, there's been, if you go the open-ended side, there have been accusations that maybe some managers are resting on their laurels or just trying to fit in with the crowd. You can't do that in the trust space because you've always got someone looking out for shareholders' interests and maybe looking to move you on if you're not doing that, I guess. One of the things I wanted to touch on, and it's actually probably a good segue into the pros and the cons, because we have to provide balance. I think I was going to ask you about downsides, and then I thought, well, actually, gearing is something that can be a pro and can be a con, but a lot of people won't be familiar with that process. I wonder if you could shed some light on it.
Yeah, so gearing is investment companies' ability to borrow money to make further investments. It's known as leverage in the US. It's essentially borrowing money to make more investments. It's something that investment companies have the sort of structural ability to do. It's something that sort of seems to be fairly well known as one of trust's attributes. It is something that contributes to investment companies' long-term performance. So just to sort of put a few numbers on it, over the last 10 years, the FTSE All Share has returned 91%. The average open-ended fund has returned 103%. But investment trusts, the average investment trust has returned 219%. So gearing along with the closed-ended structure and the ability to invest in a wide range of assets, is definitely one of the things which makes long-term returns one of investment trust's strengths. But there's no two ways around it. Gearing does add risk, and it does make investment trusts more volatile than other types of funds, which is why we'd always say that investment trusts are suited particularly to long-term investors, 5 years as a minimum, but preferably 10 or more when these structural benefits really, really do come into their own. I think just the last thing I'd say is that each trust use gearing in different ways. Some sectors tend to be more highly geared than others. Around half of investment trusts currently have no gearing at all. And across the whole investment trust industry, the average level of gearing is 8% of the average trust's portfolio. So it's relatively modest, but it's just one of the tools that investment trusts can use.
Yeah, thanks. Yeah. And I think fees tend to get a lot of attention in the space. I think with any pooled vehicle, they tend to, dominate the headlines a lot of the time. And there can be throwaway comments about kind of trusts being expensive relative to just buying the shares yourself. Do you think that's justified?
I think that investment trusts are actively managed, so you will always pay for active management compared to a passive product. There's just no two ways about it. But there's no real one-size-fits-all approach to fees for the entire investment trust industry. They really do vary between trusts. Several investment trusts are in the FTSE 100. They're very large companies. And when you're operating at significant scale, the economies of scale means that you can actually bring down charges for shareholders. Many large investment trusts operate a tiered fee structure. So as the assets grow, the charges fall for investors. So there's many large investment trusts with actually quite modest fees, considering you're getting active management and in some cases exposure to unlisted companies. But there are no two ways about it. If a trust is providing access to a very specialist area, something that is more resource intensive, takes more time, something like specialist property or private equity, it is just a bit more expensive, but you'll be getting something back for that. That's specialism and expertise.
Yeah, and I think people forget what they're actually paying for. You're paying for that background analysis. Sometimes these trusts have huge analysis teams. You've got that board of directors that you've talked about. Is there anything? I'm trying to think of. Is there anything else that you'd be paying up for? Because I think the notion is that you're just lining the manager's pockets, which isn't always really true.
I think the other thing I'd say is that because investment trusts have a closed-ended structure and because they're companies, they can invest in a much wider range of assets than other types of funds. So particularly liquid things, like I mentioned, so they can provide access to a whole world of unlisted companies, unquoted companies, in some really, really exciting areas. So, space technology, fintech, emerging biotech, renewable energy infrastructure, things like wind farms, solar parks, battery storage. There isn't a way to access these actual assets, listed. Investment companies offer that. So you're being able to access these things, which are just otherwise would be very, very difficult, if not impossible, for an individual investor to actually access. So there's definitely those benefits. And also income benefits, as well as providing access to a wider range of assets. Investment companies are really, really well suited to investors who are looking for income. Unlike other types of funds, they can save up to 15% of the income they receive from their portfolio holdings each year and put that away into a revenue reserve. So if you're buying an investment trust for dividends, this is a huge advantage because it means that investment trusts can put income away in good years to then pay out when times are more tough. So take an example of last year, the pandemic hit the entire world, the entire business world, the entire economy extremely badly. In the UK, dividends fell 41%. But investment trusts, because they had built up revenue reserves over many, many years, almost 9 in 10 investment trusts were able to increase or maintain their dividends to shareholders despite what was going on in the wider world. So, there's definitely structural benefits that you pay for with trusts.
Yeah, and maybe picking up on that, I was going to ask you, but I may as well ask you now about, you've got access to those private opportunities, and then that really important income element that you've mentioned there. Who then buys trusts? Who takes advantage of? Is there a certain type of investor that takes advantage of these things? Do you see there's certain type of persona that will opt for trusts over something else to take advantage of these rules?
Well, what we see is that when investors begin investing in trusts, they tend to really like them, and then they tend to sort of become advocates. So your typical investment trust investor will have been investing in trusts for a while and probably has a portfolio of trusts. But we're seeing younger investors become more and more interested in trusts. They could well have had parents that have recommended trusts to them, but also I think it's the fact that they provide access to these exciting areas, things that you see around you, apps that you're using, energy infrastructure that's contributing to a net zero future. And also because they're companies, you have the opportunity to actually vote and take part and be a sort of a member or shareholder of this company. So I think for younger investors who want to get involved with their investments, I think that's why it's attracting younger investors as well.
Yeah, and I mean, I think about the income reserves, really quite important. As you said, anyone who's relying on a consistent income stream, I'm thinking about maybe someone in retirement. Last year would have given them palpitations with all of the dividends just dropping left, right, and center. Whereas trusts, if I think about, you think about a few trusts in the sector that didn't actually stop any dividends and just kept on paying them because they were able to through that reserve. So I think that's kind of handy for retirees as well.
Yeah, since 2008, when interest rates have pretty much just been nailed to the floor, investors have had to look elsewhere for income. And with more and more investors having to take control of their own pensions rather than sort of work providing a defined benefit scheme, more and more investors are taking control of their financial future and their pensions. So investment trusts' income advantages have been hugely popular over the last sort of 10 years or so. We have a group of investment trusts called the Dividend Heroes. They are trusts which have consistently grown their dividends to shareholders for 20 years or more. So 20 years might sound like quite a lot, but actually it's just the price of entry to become a Dividend Hero investment trust. There's 6 which have raised dividends consecutively for more than 50 years. So, the trust that's actually raised dividends the most consecutive years is called City of London Investment Trust. It's probably well known to many of your investors. The last time it didn't raise a dividend was when the Beatles released Sgt. Pepper. So, if you've been a shareholder in a City of London Investment Trust, your dividend has been going up every year. And you think about what's happened over that time. We've had huge market setbacks. We've had the dot-com crash. We've had the global financial crisis. But investment trusts have been able to keep raising their dividends. So, not all do. It's up to the board of an investment trust to decide on a dividend policy that's in the best interests of shareholders. And, dividends are never guaranteed. But it's just such an extra benefit having this structure that enables trusts to do that if they decide to.
Yeah, it's a sign of long-term investing when you measure it in decades and half centuries, isn't it? I think moving on now to the AIC itself. So, what are you? What do you do? What do you sit in the industry, and what's the purpose?
Yeah. So the AIC, the Association of Investment Companies, is the trade body for investment trusts. Broadly, our work is to help our member investment trusts deliver the best possible returns for their shareholders. So we have a public affairs team that lobbies for the best tax and regulatory environment for investment trusts. Our members' investment trusts are the boards of directors, so they're non-executives. They tend to have specialist knowledge, which is why they'd be a good director for their particular investment trust. So, they might be specialists in science if it's a biotech trust, or Japanese smaller companies if it's investing in Japan, for example. So we'll provide events and training to make sure that directors are up to date with what's going on across the whole industry. We have a very active website where a huge amount of data on each of our member investment trusts is available for free to investors. Our web team works very hard to make sure that's updated every day with performance data, portfolio information, fees and charges. It's a huge resource. So that's to help try and inform investment trust investors' decisions, or bring people who might be new to trusts and sort of help them understand what they are and how they can help. And then we also have the communications team, which is my team, which works to promote investment trusts to the widest possible audience: journalists, private investors, financial advisors, wealth managers, making sure the benefits of investment trusts are known by as many people as possible.
And I think, we've probably got time for one more. I'm going to squeeze it in here. I think one really important consideration broadly among investors now is ESG, those environmental, social, and governance standards. Basically, shorthand for sustainability, really. And I think it's something on private investors' minds. I was just wondering, do you think it's on professional investors' minds? These heads of these trusts, is sustainability something they think about? Is it even something they could add value to private investors who are looking for those sustainable investment opportunities?
Yeah, in one word, definitely is the answer. I go to lots of investment trust managers' presentations, and almost all of them have an ESG process. It's part of most investment trust investors. So investment trust managers' investment framework. So how does this potential investment fit with the investment trust's policy or strategy towards ESG? So yeah, I'd say it's pretty all pervasive through almost all investment trusts' investment processes. But sort of just moving on from that, investment trust, there's a huge range of options for investors who want to be involved in sustainable investments. We have an environmental sector, which houses investment trusts specifically investing in green and environmental technology, things like recycling, water treatment, reverse vending machines to make the most of materials. We have very, very large renewable energy infrastructure sector. So these are trusts which will invest in solar parks, wind farms, battery storage, the real building blocks that a net zero future will require. That's been a very, very big sector. But also there's social impact opportunities as well. We have investment trusts which own specialist property, care homes, accommodation for the homeless, social housing, trusts which are investing in assets which are doing real social good. So, those are specialist opportunities and something which it's pretty much impossible for retail investors to otherwise invest in. So, there's a whole range of opportunities that investment trusts can provide.
So a definite yes there then.
Just the other thing I'd say is that because it's so diverse, for individual investors and for investment trusts, everyone's approach to ESG is different, and we have a hugely diverse industry. So thinking about how we could best help investors, we gave each of our member investment trusts the opportunity to publish their policies and approach to ESG on our website. So if you go to our website and look for any of our member investment trusts, next to all of the information I was talking about, things like performance and portfolio, there's a tab on ESG, which will give you how they think about ESG, what their policies are. And our aim is that investors can then use the ESG information to help inform their investment decisions. So that's available on our website.
Excellent. Emily, I think I could talk to you about this all day, but I won't keep you. I think we've run out of time there. Thanks for coming in to join us.
Thanks, Dan. Great to speak to you.
And thanks very much for watching. If you'd like to know more about the AIC or just trusts in general, feel free to visit the AIC website, or you can visit the explainers on the Freetrade Learn Hub. Thanks for joining. See you again soon.